let's get started. So first of all, um, there's going to be a Meet the Author event that I'm going to be attending. This is at Cambridge Central Library on Saturday at 11 o'clock. So it's a 2 hour Meet Your Local Authors event at Cambridge. It's at the Cambridge Central Library. So if you are in the area, please do drop by. There's a bunch of interesting authors, both fiction as well as non-fiction, coming in. You can meet the authors. You can talk to them. You can have a one-to-one discussion, and you can also get signed copies of books. So to start off, why do we focus on younger generation? Why are we looking at sustainable companies? Why are we interested in companies that are profitable and sustainable at the same time, right? This is ecoeconomics as such. But why are we doing this? This is not ESG. So we are not here to tell you that you've got to compromise profitability in order to be sustainable. No, you've got to be profitable and sustainable at the same time. And in most of the cases, you are more profitable because you're sustainable, right? So that's the difference in this thesis. But beyond all this, it's a question of pensions. It's a question of the future of this economic system. And again, I'm not talking about planet and just say the planet can save itself, right? So I'm not getting there at all. I'm not going to give any sort of a utopian drama. Now, the economic system in itself is built on the basis of pretty much like a pyramid scheme, right? You need money when you're older, when you're not able to work, retirement, call it pensions. There are some assets that you want to retain. There is there is a mechanism to take care of the aged aged part of the population, aging part of the population. And for that to happen, you need more and more younger workers to join the workforce, be in full employment, pay taxes, national insurance, etc., uh, so that the public services will work, so that there is investment opportunity for people as they start gaining momentum in their life, start going through various stages of their life. There is more momentum as such, and you have a certain corpus with which you retire, maybe as a retirement fund, maybe as a pension. Your company gives you a certain pension, and then you have your own personal pension, etc. State pensions, of course. For all this to work, this pyramid has to work. And that is ecoeconomics. And that is ecoeconomics too, which is investing in a youthful, sustainable market. So where is sustainability coming in here? He said it's not ESG. I'm not going to talk about saving the planet. Where is sustainability coming in here? Effective use of resources, efficient way to use energy, reducing cost, reducing wastage, thereby you are more effective. We are all living within a certain environment. Unfortunately, our systems currently look at the environment and social considerations as externalities. These are not externalities. These are the systems within which we work. And that's the exact reason why we are looking at a sustainable, youthful market in which we invest in. Now, we all like to think that the global economy is always growing and it's in a fantastic stage and everything is hunky dory. We like to believe that. But uh, if you look at the global macroeconomic scene, look at the stage where we are, the cycle where we are in a slowing or declining cycle. And that cycle hasn't changed since the pandemic. and it's unlikely to change for the next 5 or more number of years. So globally, we are declining, and this doesn't mean every economy in the world is declining. There will be some pockets of growth. So you can spot that and you can look. If you are a growth oriented investor, you can look at some of this. But for the major part, most of the developed economies are in that slowing, declining kind of a stage in the macroeconomic cycle. When something like this happens, we immediately want to understand uh, what is the policy channel underlying this. And the answer is you have a divergent policy channel over here. The US Fed is divergent from everybody else, um, right? Every other major central bank. So it kind of triggers both the policy related flows, money flows, as well as the risk related money flows. So we have said global economy is kind of slowing. There will be some pockets of growth here and there, but largely it is um, slowing or declining. And then we said there is basically a divergent policy environment that we have currently. With that sort of a situation, which are the most um, safe sectors to invest in? Now, the way I look at it is people still eat. They may eat lesser food. They may eat stuff that is cheaper than what they would have usually, but they're still going to eat. They're still going to pay utility bills. They're still going to pay rent and mortgage and whatever. They're still going to commute to work. They may not take a long trip. They may not take a holiday at this point, this particular point in time, but they're still going to commute, etc. They still send their kids to school. There's still educational investment. They still get sick. And when I say sick, and then you say healthcare, I'm not looking at companies that have a 15, 20-year time frame before their first drug comes in. Now, look for companies that already has cash flow, right? Now, with that being said, then you have to then look at, what are the sort of characteristics of that company that you want to invest in. There are three things that I would suggest in this sort of environment. One is look for companies that have a good competitive advantage, a moat, right? Wide moat. So that's one. Secondly, look for companies with lower amount of debt. So compare it to their peers. The lower the debt, the better it is. Uh, Thirdly, I would also look for pricing power. Are they able to price their products right? Are they getting volumes for that price? So with these sort of a situation, you get into a point where you say, okay, if all that's happening, the company's valuations are going above the roof. You want to look for companies that are fairly valued. You have to understand that the market does value certain brands, certain companies higher than other ones. But you want to look for companies that are fairly valued. So with that sort of a combination, looking at this, somebody told me the other day in the US market, I'm looking at just a handful of stocks. That's fine. Build a portfolio with just that. That is your base. That's pretty much the foundation. And as things right now, you've got a situation where there isn't a lot of data available about the US economy because of this government shutdown, this delayed uh, um, information release. There is additional data that's coming in from external sources, but that's the stuff that you have. So looking at the UK as well, right? Retail sales, consumer spending that we are interested in. When you look at it, we might see a small uptick, month on month, etc. But go back a few years, at least 2, 3 years, to see where we are. That gives us an indication that yeah, there is uh, slight optimism, but the reality is, we are way behind where we started off after the pandemic. with that reality, it's better to choose, uh, investments that are safe, investments that are at this sort of I would say, um, the foundational stage which I talked about. People are still going to eat. People are still going to commute to work, etc. etc. Their cars will still need servicing and all that, right? So that's the area that I would probably look at, when we are considering various stock investments. Now, now going from there, from uh, that sort of a situation, we also have to understand that various markets perform differently, right? Now looking at the U.S. stock market, we talked about this a few times in the past. You have the S&P 500, which has about one third or rather 35% of its weightage going into just seven stocks, the seven large technology stocks. So are we saying that the US economy is just defined by these seven technology stocks? The answer is no. The answer lies in the 496 other stocks that are there on the S&P 500. And look at, it's the Dow Jones. Now, as an index investor, um, our our um, our biggest risk is the fact that the rebalance of dates for the index doesn't take place that frequently, right? So it's probably going to be once a quarter, or within that, the markets change, as the circumstances change drastically. So consider that you can still pick a number of uh, you know valuable investments among the 496 other stocks on the S&P 500. You can look at the FTSE here in the UK. You can look at Nifty if you're in India. So there are a number of companies that are fairly valued, not at the 168 times of earnings kind of evaluation that we have for technology stocks. That's a sure shot, high risk investment, as far as I can see. So why does that happen though? There's one side which is basically the valuation related ceiling, but then there is also the technical ceiling because there is money that is flowing in because of the policy channel and there is channel coming in. So that's the reason why you do find that some companies are valued quite a lot more than the others. So over the past, I think 2 weeks or so, we've recommended a number of stocks. So I'm just going to look at which ones we've recommended more recently. Um, During Dr. Pepper, Nucor, the green steel manufacturer. There is Intel, IBM. We recommended GE Aerospace, Bank of America, um, American Express, Delta Airlines. So that's that's the list that we've recommended. All of this information is available to you on SoumyVJ.com. You see the summary, and then you can go into the detail. We use a quantamental model, quantitative plus fundamental kind of a model, in order to research these stocks. There are a number of companies that we are looking at currently. So I'm going to look into a few of them currently. Right? There is Cirrus Logic that we are studying currently. There is HCI Group, the insurance company. There is Catalyst Pharmaceuticals that we are looking at. Um, and then there is among the technology companies, there's Yelp that we're looking at. I know in the past we also mentioned Netflix, but of course Netflix is overvalued. So we said, yeah, uh, take a fair chance with Netflix. Right? We did not actually recommend it. We said, hold if you're already investing, hold on to it, or maybe slightly, diversify from there. So that's pretty much the kind of list of stocks that we're looking at. Happy to take any questions. Um, Feel free to jump in, write a message in the chat, and I'll leave the chat open for the rest of the day, so you can jump in and leave your comments in there. Right. Thank you.